Your credit score is one of the most important and mysterious things that will impact your entire personal finance and your path to financial freedom. If you don't know what your credit score is and you don't know how it's impacted, this is the video for you. When I first started learning how to invest and I wanted to go on that path of investing in real estate and really secure my future financially, I had no idea really how important that little scorecard or that report card was until I was ready to buy my first house. Think about that. I was ready, I was saving, I was doing all the things right. I had the money right in my pocket to buy my first house. I thought it would be easy for me to just get a loan. Well, reality check, something that they don't teach you in school. I had no idea my credit wasn't in the best shape. And the loans I was getting, first off, it was very difficult. A lot of banks weren't even letting me get a loan, or I wasn't being qualified. And for the loans that I was approved for, the interest rates were so high that it was just killing my overall profitability. And the investment didn't make any sense. So from that day on, I learned everything I could about the credit score, how it's calculated, what it means, and the easiest ways to impact that score and move it in the positive direction. And now my score is 750 plus. So I'm in a great spot. I now have over $7 million in loans and assets in real estate. None of this would be possible if I didn't have a proper and solid credit score. So for you, you need to make sure that if you're getting into the investing world or you're just starting out and you're young, please make sure that you understand, because this video is gonna help you when you are on that path and you want to become financially free and you want to start actually working on your wealth and you're in a position to do that. Well, we all know the only way to get rich or to get, ahead in this world is to leverage debt, is to leverage loans. First things first is, what is your credit score and how is it calculated? Well, in simple words, your credit score is a number that is used to represent how credit worthy you are. So the higher the number, the better; the lower, the worse. The higher the number it is, the more credit worthy you are, and vice versa. The lower the number is, the less credit worthy you are. So the credit score is calculated with 5 factors in mind: your payment history, how much credit you have, how much debt you have, the amount owed, the length of credit, the mix of credit that you have, and how often you're applying for new credit. And in the credit score, the 3 most important factors are the payment history, the amount of credit that you owe, and the length of the credit. Those 3 components give an overall weight of 80% of how the score is calculated. So very simply, if you can understand those 3 concepts or understand how those 3 things are calculated, then you're going to be on a good path for a good credit score. Okay, so now that you understand how the credit score is calculated, let's actually get your credit. How do you actually get it? Well, it's really easy. You can go online. There's multiple websites that give it to you for free through Equifax, TransUnion, Experian, and everyone is eligible to get a free report on annualcreditreport.com. Every single year, you should always be pulling that credit report and make sure that everything on that credit report makes sense and it's accurate. This is what got me when I was applying for my first mortgage. When I pulled my credit score and my credit report, my information was wrong. It was showing that I was a student even though I was working full time. And that looked horrible from the bank's eyes. They did not want to give a loan for a house to a student. So something so simple stopped my whole process in investing in my first real estate, and it delayed me quite a few months because of that mistake. So you always need to pull your report, look through every single line and information that you can. Your personal information, the number of bank accounts that you have, are all the accounts listed there accurate? Are they the ones that you've opened? Is there any mistakes? Are there any notes? Any remarks? All of that is there. It's very clear to see once you actually download that report for yourself. You'll know very easily what's there that's accurate and what's a mistake, and that's your chance to fix those mistakes and get it corrected. That is super important, and that's the first step. So now let's get back into how you actually maintain or increase and improve your credit score. Now that we know that the credit score is calculated based on those 5 factors, and we know the 3 primary ones are the payment history, the amount of credit, and the length. If you understand those 3, you can really make an impact on your credit score very easily in a short period of time. Here's how I did it. Number 1 is the most obvious. never miss a bill payment. No matter how small or what type of bill it is, your phone bill, your credit card minimum payments, utility bills, whatever bills that are under your name, make sure that you are paying those bills on time. If you miss a payment and that gets to the credit bureau, that will greatly impact your score in a negative way, and that is something you just want to avoid. Nobody wants to give a loan to someone that has a history of missing their payments. Why would anyone give a loan to someone like that? It doesn't make any sense. So always be responsible and just pay your bills on time. If you do that, you're already in a great spot to improve and keep your credit score at a good level. So the second thing is you should be paying more than the minimum, because it's much better to pay off like credit card debt and pay more than the minimum payment, because that shows to the credit bureaus that you are serious about paying off your debt. You're responsible. And think about that from a loaner's perspective. If you're gonna give a loan to someone, wouldn't you rather give a loan to the person that's gonna pay the minimum payments and also give you extra money whenever they possibly can? That shows like that person that you're loaning to is obviously very serious about paying off that loan, and the chances of them defaulting is much lower than someone that has a history of not paying anything or just paying the minimum balances every month without really paying off the entire principal. Also you should be paying off the high interest debts first, right? This is just, again, it's a good thing to do in general. Personal finance strategy is always to pay off your high interest debt first, because you're just paying so much interest and you'll save a lot of money by doing that. But again, it also just shows to the credit bureau that you're serious about your debt, you're responsible, you know which ones are costing you the most, and you're paying those off more quickly. So always try to figure out which debt that you have today, which ones have the highest interest, and just pay those off as much as you can first. All right, so the second aspect, like we talked about, is how much you owe. And this is something, once you understand, you can really play around with to work in your favor. And let me explain. When they talk about how much you owe, they don't actually care about the number, the dollars that you owe. It's the percentage of how much you're using compared to what you have. So just for example, if I have a $10,000 Visa or a credit card and I'm using $3,000 of that, I owe $3,000, then my credit utilization is 30%. I'm using $3,000 out of the $10,000. That is how they calculate how much you owe. They calculate the percentage, the credit utilization percentage. And that is critical, and that is very subtle. That is something that you need to understand. Now, what happens if you have that one credit card, like for someone like me, I only had one credit card and I was using, most of it all the time. I didn't realize that having multiple credit cards could actually help me and adjust my percentage. So instead of me having one $10,000 credit card, I applied for two more. So I had three $10,000 credit cards. Now my overall amount that I owe or have to use is $30,000, but I'm only using $3,000 of that at any given time. So my percentage used, my credit utilization was always around 10 to 15%. And that just looks so much better to the credit bureaus, and my credit score was much better, funny enough, by getting more credit that I just wasn't using. So this is a very practical strategy that can help you. So in my instance, in my case, that's what I did. Instead of having just one credit card, I had multiple credit cards. One that I never used ever. It was just in my wallet, but I never used it. It was just there to keep my utilization percentage low. And the other two credit cards, one was for my everyday purchases. I was using that for my grocery shopping, any small purchase that I needed, during the day. I just used that credit card for my small day-to-day purchases, and then I would just pay that off instantly. And then the second credit card that I had a bigger limit, but it was only used for bigger purchases. And that was just a way for me to avoid having to put all my expenses on one credit card. I was able to split them up between the two, and anything small, I could just pay off immediately. And anything that was a little bit bigger, I had that one credit card that was just continuously paying off whenever I could. By doing that, my overall credit utilization was low from a percentage perspective. So if you are in a position where you're seeing that your credit utilization is very high on your report, that just might mean that you can get more credit, to offset that, or you should just pay off the credit cards that you have today to get that credit utilization lower. Third aspect that's really important is the length of your credit. How long have you had your credit history for? And the only way to obtain that, or the only way to actually create history, is to have credit. So this is why it's so important. If you do have young kids or people in high school, or you are in high school today or in your university, you're young, you'll figure out a way to open up a small credit card on your name. A very small credit card. Just start your credit history as soon as you can. Don't use it, don't maximize it, because then you're gonna offset and make your score lower. You be responsible with that credit card and just open it up as early as you can. Because now on paper, by the time that you're ready to make some serious investments in your life and buy your first house, or get that car, or you need that loan, the history is there. It's going to show that you've had this credit card or this credit history many years, even though the number is really small. It doesn't matter. The history is there. So always try to figure out a way, if you're just starting out, to get a credit card or get some sort of credit, a loan to you on your name that you're responsible for, and just do it as early as possible. And third is to have the oldest bank accounts and your oldest accounts, as long as it's not impacting you in any way, keep those accounts open. If you see an old account open and it's an account that you forgot about, don't worry about it. Keep it open as long as you're safe with it and it's not going to impact you. Keep it open, because the amount of history, the time period that the credit bureaus are looking for is based on the oldest account. So if you start closing those old accounts off, well, then the credit history is also going to be erased. So just make sure you look into that and don't do anything drastic, but make sure all the errors are, inaccuracies are fixed. So now that you know how to get a good credit score and you're prepared to invest properly, check this video out if you want to learn how to save and invest in your first real estate rental property.